Hi, thanks for listening. This is Cordant's market update for September 10th, 2020. As always, we'd love to hear from you. If you're a client or if you have our email address, feel free to shoot us an email directly with any comments, questions, feedback, or topics that you'd like us to cover in the future. If you're not and you don't have our contact information, you can simply go to cordantwealth.com. There's a contact us form there and simply put in your comments and we will get back to you. Today, we're going to hit three things. We're going to take a look at where the markets are. We're going to look at some health and economic data like we do in all these market updates. And then we're going to take a look at what's going on in the market right now through the lens of technology stocks. This year, pretty big rally in technology stocks through the pandemic as everybody's transitioned from working from home and doing everything else from home. But lately, we've seen a sell-off there. So just looking at what's going on there. Market year to date, again, about a 34% drop. That's pretty much in line with an average bear market. However, it's happened much quicker than a typical bear market. And since then, we've seen a rally recovery up about 53% from the bottom. And this is as of market close yesterday. Obviously, we were up a little bit more than that, recouping some all-time highs in the S&P 500, and it's sold off a little bit from there, but up 53% since the bottom in March. One point we made in a presentation at the end of last month was global diversification still does matter, even though it hasn't helped in 2020 if you're a US investor. I ran across this chart. I thought I would share it. The point we were making back in March is even though it hasn't benefited you in 2020, it still makes sense to invest that way going forward because we never know and we don't want to be concentrated in one market. There are long periods of time. The tech bubble in the subsequent decade was a pretty recent example of how this can play out. So the US market, at least the largest companies, the large cap stocks here in the US, had a 10-year period where they actually had a negative total return, leading us one reason to promote this notion of global diversification. Well, ran across this chart and it just shows the benefit over a shorter time period here. So this is since 9/2. Don't read a whole lot into this. Again, this is a very short time period, and it doesn't necessarily mean that the rest of the year, the rest of the world is going to outperform the US market. But kind of does a good job of showing that over certain periods, markets across the globe can move differently. So you have the US and China all the way on the left being the largest market decline since 9/2. Average market across the globe, 1.8% drop over that period. So there is a difference. And not all markets are going to be correlated during all periods. And some benefit to some diversification. I think one of the things that's leading that the decline in the U.S. and the Chinese stocks over this period has been they have a higher percentage of industries in technology in the indexes or in their markets, and that's led to some of the decline here. So just thought that worth noting and sharing. From a health and economic data perspective, primarily, again, this economic crisis this year has been driven by the health crisis. So important to view how we're doing, at least here in the US, and things seem to be continuing to trend in the right direction there, which is good. Obviously worth keeping an eye on. From an economic perspective, again, two things we're looking at here is the data coming in better or worse than expectations? That's one of the things that's going to drive the market. And then the other is what's happening in the future. So this is just a reminder that the market's going to be reacting to the expectations for the economy next year, not so much what's going on in the economy today. So what is going on today and what is that forecast for the future? Here we're looking at selective economic data ending last week. And again, we still continue to see this data coming in better than expectations. So the manufacturing and the services index beating consensus, unemployment rates, new jobless claims and payroll numbers continue to beat expectations. So this is a good thing from a market perspective. It's also just a good thing from an economic perspective, obviously. The other place that shows up is the Citigroup Economic Surprise Index, which we have been looking at every time here. And again, this is just across a bunch of different economic indicators. Is it coming in better or worse than expectations? So 0 would mean it comes in exactly at expectations. Anything above 0, it's coming in better. Anything below 0, coming in worse. And the level of surprise has been kind of unprecedented here this year, or post-March really, or post-April. That number is starting to come down some, which we would expect as the bar gets raised, it becomes higher and higher to beat those expectations. So we see this falling, but still a very high number, 183. So anything above zero, again, is better than expectation. So the data continues to come in good from an economic perspective. Now on to our topic of the week here, tech stocks, and is this a a redo of the tech bubble in 2000? This is just a really quick recap of what things have looked like over the past 3 months. This is the S&P 500 and the NASDAQ, which is a tech-heavy index. And as you can see, the NASDAQ has been outpacing a broader S&P 500 index, but you can see that big decline starting really about September 1st. So this is what we've been talking about. If you've been paying attention to the news, there's been a lot of news around how some of these technology stocks, Tesla, Apple, which is the largest company in the market, but still been rising very much this year, been having some huge gains. And so kind of what's going on there and what's fueling this decline recently. I think there's kind of three things that are worth paying attention to. So one is the options market, one is sentiment, and one is just the concentration that's out there in tech stocks. And obviously, none of this is going to dictate or be able to forecast where things are going, but it kind of helps explain some of what's going on in the market right now. So in the options market, and we're going to look at this a little bit more, very much some bullish behavior going on there. So the NASDAQ, which again is very tech heavy, has the highest call put ratio, meaning calls are bets based on a stock going up, puts are bets on a stock declining or protection on it declining. So there's a lot more people betting on NASDAQ individual stocks going up than they are protecting on the downside. That ratio is at the highest since March 2000, so kind of at the peak of the tech bubble. So that's one thing that's interesting that's going on that we'll look at. From a sentiment perspective, especially if you look at broader sentiment indicators, not so bullish. So it seems to be kind of concentrated in individual stocks in the tech-heavy NASDAQ market would be the conclusion there. And then concentration, which we'll get into maybe some implications of that down the road. Actually, the market is pretty concentrated in the largest companies. So think about your Microsofts, your Apples, your Amazons, etc. Highest level since 1970, and there's some implications of that, which we'll get into. So first, just take a look at what we are talking about here in the option trades. And what you can see is a lot of interest, call interest, which again is a bet on stocks going up, a lot of interest in individual companies. So here is Salesforce, Facebook, and Adobe, all tech stocks. And in the last couple months, you've seen this interest or the number of total contracts increase. Now, why this is so important is it's not just trades in the option market. So if I'm selling you an option, if I'm a desk or a trader and I'm selling you options, what I'm probably going to do is I don't want to sell you the option and take on all that risk. What I'm probably going to do is sell you the option and then go out there and buy the company stock to hedge my risk. And so what this is doing, what a lot of people are talking about, is as more options and more options are traded, it's forcing people to go out there and buy the stock to hedge their bet. And so that's can have the effect of making these stocks rise in price rapidly. But on the flip side, kind of what we've seen the last week is it can also make them decline in price quickly when that buying stops. That's one thing to pay attention to, is just the rising level of options. Also, what's interesting is the rising level of option trades in individual stocks. So there's a lot going on in this chart, but what I would want you to focus on is this pink line. So go back here, this pink line here. And these are option trades in individual stocks that are bullish, that would be betting on the stock going up. And you can see typically these are option trades across an index. So think the S&P 500 spread across all the biggest stocks. You can see a pretty even ratio between puts and calls, meaning bullish and bearish bets. Here, what we've seen here on individual stocks this year is just this number has ramped up. So a lot more people using options to be bullish on individual companies. And again, that can have the feedback mechanism of people hedging those trades by buying the stock, driving the price up, but it can unravel rapidly. That's what's going on in the option market, specifically with a lot of technology companies. Sentiment more broadly, this is the American Association of Individual Investors. They do a sentiment survey where they ask their cohort, are they bullish, are they bearish, or are they neutral? And this goes back to 1987, interestingly enough. And what you can see is in this chart, anything above zero, this is just the spread between people who are bullish and bearish. Anything above zero would mean more people are bullish. Anything below zero would mean more people are bearish. And what you can see is in their survey, actually below zero. So more people are bearish than bullish right now. So the conclusion here is while sentiment, especially if you look at option trades, is very bullish for technology stocks and in the NASDAQ, that's not spread across the rest of the market. And I think this is a good thing. Typically when sentiment gets way too bullish, the market kind of gets overextended and that's not a great time to necessarily not a time that you would want to be overly bullish as well. It's kind of the saying of be fearful when others are greedy and greedy when others are fearful. So that's the sentiment. Checking in on concentration, a couple interesting things here. This is just a chart of the percentage that the top 20 and 5 firms make up of the total US market cap. What you can see is, since 2017, that's really increased. So the top 5 largest firms now make up about 25% of the US market cap. This goes back to further than this, back to the 70s, and kind of at the level that we've seen in 1970. And so there's some implications of this. One would be just from an investment perspective, you might want to look outside the US to get some more diversification. Also, if every investment is just purely market cap weighted, especially in large cap stocks, you're not getting as much diversification as if you own, say, small company stocks or are using kind of a different approach to get your investment allocation. Another kind of interesting chart here is Apple, just in terms of market cap, actually for a period had a larger market cap than the entire Russell 2000 index. So the way Russell splits it is the largest 3,000 companies. The top 1,000 is the Russell 1000, and then the next 2,000. So these are small companies, but the next 2,000 companies makes up that Russell 2000 index. So for a period, Apple actually was worth more than the smallest 2,000 companies as defined by the Russell 2000 index. So you can see how that's changed over the last 2 years, but that's pretty remarkable. And then the other thing to look at is obviously one of the things that's driving this increase in concentration has just been the performance of these largest stocks. They've done pretty well. And this is kind of harkening back to the tech bubble where we saw a similar phenomenon going into 2000, and we see that now. And obviously, kind of the theme of this is these things don't tend to go on forever. They tend to reverse. That's exactly what we saw in 2000. So the implications of some of this concentration or what might change specifically with large companies or with the tech companies, I think there are a few. A lot of these are based on either changes in the economy or changes in regulation. So from an economic perspective, a lot of these tech companies that have really thrived have done so because of the conditions, the health conditions that we're in. Everybody's working from home. Zoom company has soared. Everybody's using Amazon more, et cetera, et cetera. So that's kind of driving some of this. So what we're looking at here is a correlation, which I thought was an interesting way to do this. This was done by Morgan Stanley. JP Morgan. And what they looked at is the correlation between growth stocks and some different news flows. So anything in brown there on the right, the election, vaccine, stimulus, actually is negatively correlated with growth stocks. So the point there is, the first point that I was making is a vaccine, more stimulus, anything getting the economy back to normal is actually negatively correlated with growth stocks. So a resume to normal isn't necessarily beneficial to these companies that have thrived based on everybody being stuck at home. The election is interesting there because of some regulation. So really across both parties, there's been more talk about increasing regulation or potentially even breaking up some of these large tech companies that are dominating their industries. And so obviously that would be a negative. So if we're looking for things, what might reverse this trend of tech really outperforming? It's kind of those two things, regulation and a resume to normal life. Some of the things that have been beneficial, at least based on correlation, is the Federal Reserve, inflation, and interest rates. I think all these things are kind of tied together, but lower rates benefit these growth stocks, which may not return cash flow today, but out in the future they do. And so the lower the interest rates, the less impacting it is to wait for those cash flows into the future. So just a couple things to think about there in terms of what might change this trend this year and even going back beyond this year of tech stocks outperforming. And I thought this using correlation was an interesting way to look at that. So hopefully that helps if you're thinking about what's going on in the markets, what's going on with tech stocks and the sell-off that we've had lately. And again, if you have any questions, please reach out and let us know. We'd love to hear from you. Thank you for watching. Have a good afternoon.